Okay, now we're going to touch on time frames, which is very, very important in trading. A lot of people don't really understand how time frames work on charts, and it's very important you do understand so you can avoid the blue collar despair, what we call the blue collar despair. So, calibration. You have to calibrate time frames in order to correctly combine the fundamentals with the chart. So low time frames like hourly, 5-minute, etc. will not work. It's just too much noise. The price movements are too meaningless. You need to be using higher time frame charts such as daily, weekly, monthly, and even quarterly for it to work correctly so the fundamentals and the price action align. Now I'm going to do a quick little demonstration on a charting platform for you guys so you can see what I am talking about. All right, so this is the US dollar Mexican peso cross, and I have it on the daily time frame right now, but first let's go down to the lower time frames, like 5-minute charts, for instance. And you can see how crazy the price action is, and all these huge spikes up and huge spikes down. They're really meaningless in the grand scheme of things, okay? So we don't want to be in these low time frames. Even an hourly chart is honestly too much noise. A lot of spikes and a lot of meaningless movements. So if we back out to the daily, we can get a lot more clear on the actual long-term trend of what we're looking at, okay? And this is the lowest you'll want to go. Weekly is usually where we want to be. And now you can start to see nice long-term trends forming, okay? And even monthly, right? Monthly gives us an even more clear picture of what's going on, all right? So we can easily see when the Mexican peso decided to break out on the monthly chart and run for a long time. So we need to use these high time frames to really calibrate the charts with the fundamental outlook. And another thing I want to emphasize about charts and time frames here is don't obsess about charts. Okay, a lot of people like to spend their entire day looking at charts on every single time frame. It's not necessary. Fundamentals are slow moving and they last a really long time. So it doesn't make sense to look at a 5-minute chart in every single day's price movement, okay? High time frames are much less noisy, so stick to them. And honestly, being glued to charts all day, every day is a very, very horrible lifestyle. A lot of people glorify day trading at first, but when you realize you're just watching a price chart tick back and forth for 8 hours a day for the next 10 years, every single day, it starts to sound less glamorous. And this is what I think of when I think of day trading, right? Just you're on an assembly line. It's cool and novel when you're starting off, but eventually you're just doing what an algo or a computer can do and watch price tick up or down. It's much more invigorating. It's much more peaceful to approach the market like this, with high time frames, with a clear mind, a clear head, not a lot of stress and anxiety getting pulled around by every little tick in the market. So that's it for section 5. I hope you guys liked it. The charts, again, we're going to emphasize the charts are needed in order to simplify a complex, uncertain system that global macro markets are. Okay, and that's why we need them. Staying with the long-term trend is absolutely ideal. We talked about that with the 200-day moving average. Charting needs to be simple, not 1,000 million indicators. Otherwise, that process will break down. It's not robust enough. And we talked about how we need to look to buy or sell breakouts from key levels identified by support resistance lines or trend lines. And then finally, we just summed up here with keeping track of large time frames for correct calibration to the fundamentals. Don't get lost in the weeds down in 5-minute charts. It's a waste of time and you'll regret that decision.